Well, welcome to Nuts and Bolts, a New Venture. This part of the program is about financial projections. You know, all the stuff we've talked about eventually has to come together in a resource determination and allocation, and those are the financial projections. Now, a couple things about Charlie Tillett. Charlie was an entrant in the 10K competition way back in the day. His team had some crazy idea that an LCD projector could be useful in an auditorium like this. I think they took third place. Is that right, Charlie?
That is correct.
And you can talk about how many dollars you get for that effort. But Charlie has a great history in entrepreneurship. He's been a CFO of a startup that went public, and a bunch of other things he could tell you about. But I just want to relay the fact that what you're going to hear from him tonight, the financial projections and the template that's in the materials, has been used. I've run into it many times. The most memorable, faraway one, I was in Istanbul at a second World Entrepreneurship Conference from the GIST program, which was Global Innovation Through Science and Technology. This is a program set up by the State Department of the US to foster entrepreneurship in primarily Muslim countries. And there I was teaching, but I was also helping some teams with their pitch. And a team from Pakistan I was talking to around some energy-related thing. And I said something like, well, I don't understand the economics of that. And they pull out the financial projections. And I'm looking at it and I'd say, where did you get that? And they didn't quite understand what I meant. It was the template from Charlie Tillett from this class being used by a team in Pakistan to try to figure out how to do this energy venture over there. I've also run into it from a PhD from Dartmouth, and I'm sure other places. I use your template even today. I've embellished it a little bit more, but it's very useful. So without further ado, I'll turn it over to Charlie, and he'll lead us right through building those financial projections. Take it away, Charlie.
Great, Joe. Thanks a lot. I'm trying to share my screen so that I can share my presentation. And it says the host has disabled screen sharing. So
okay, we're going to have to enable that. You'll have to visualize it then, Charlie. Just this is the first time we've tried to do a remote presentation using this. You know, normally this is all done in person, so bear with us for a moment. Do you have it, Ping? Okay, you have the option now. Oh, there he is. Okay.
Yeah, good. Great. Let me get rid of this. And I assume you guys can all see the presentation, correct? Yes? Are we okay with the presentation?
Yes, we can see it, Charlie.
Oh, okay, great. Let's see. So tonight we're going to talk. So I'm sorry I can't be there tonight. I'm actually out in Colorado skiing with my wife, but I'm excited to share this with you tonight. I listened to about the second half of the first presentation and heard a lot of great thoughts on sharing the equity. So we're going to spend about 2/3, maybe 75% of our time talking about building your financial projections and why that's important and how to think about that. And then we'll spend about 1/4 of our time talking about what happens when you decide, hey, we have 3 founders, let's all take 1/3 of the equity, and we'll play that out, assuming that your company is successful, and we'll look at the end result there and walk through a template of all the people that you'll end up giving equity to over the course of your company. And there is a template, just like there's a financial template that you have, there's also an equity template that you can play around with. If we raised money at $5 million at a 5 million valuation or 5 million at a 10 million valuation, what difference would that make for for our equity. So we'll get to that second, but the most important part is the financial projections. I know that there are people in the audience that have, I know someone's got a microphone there. So whoever's controlling that, feel free to interrupt me at any time. I don't have any problem taking questions. And if someone would monitor the chat questions and just jump in with those questions when it seems relevant, that would be helpful.
Yes, you got it, Charlie.
So as Joe mentioned, graduated in 1991. Not only did I take third place in what was then the inaugural business plan competition, it was the 10K contest with 10,000 going to the first place team. And I think a total of $300 split between the three founders of the third place team. But it was still a great experience. It helped really launch my career because the experience that I got in putting together that business plan was foundational for the next business plan that I put together, which was for this little company, NetScout Systems, that Joe introduced me to, that had 9 employees, and I was the first non-engineering employee. We grew that over a decade to 100 million in revenue, and we went public in August of 1999. But the other experience that I had in 1991 was working at a venture capital firm, and I was the summer intern responsible for reading all of the unsolicited proposals that came in, usually via FedEx, and they would end up on my desk. And if I saw anything interesting, it was up to me to pitch it to one of the partners and get them, get their level of interest. And if they were interested, then we would proceed further. And if they weren't, then it would wither on the vine. But kind of the critical point I want you to understand is that if I didn't get around to reading it, then it absolutely had no traction at the company. So whenever you're approaching a venture capitalist, it's tremendously helpful to have some kind of introduction so that a partner there or someone at the firm has an introduction to you and is looking for what you're sending in, so that you can call them and say, hey, did you get my material? What do you think? Can we come in and chat about it? So for the decade of the 90s, I was at NetScout System. As I mentioned, we took it public in 1999. And then I joined a company that made bomb detection equipment at Reveal Imaging Technologies. I have a separate sheet on the 9 financing transactions we did. And then that company we grew to about $80 million in revenue and sold it to an aerospace defense contractor in 2010. Since then, I've been doing consulting for early stage companies, everything from helping them put together their business plans to helping them think about an exit scenario and kind of everything in between. So let me just spend a couple minutes on something that's not related to putting together our business plan, but maybe it is. Okay, so I know that when I was at MIT, we had a lot of work, and I used to spend every night in bed reading my cases that were coming up in the next couple of days. Some nights I would end up like this. But what I found, and I'm sorry that I'm not there because we could make this a little more interactive. But what I would find is the next morning, maybe over coffee, maybe on my drive down to school, maybe as I picked up the case to review it later that day, that even though I had been asleep, I had some insight into that case. And we'll come back to that and why that's relevant. I had a professor when I was at MIT who had one Tuesday night's assignment was to go home and write down on a piece of paper, spend no more than 5 minutes on it, and write down 5, 6 goals that we had that we'd like to accomplish by our 10th year reunion. These could be professional goals, personal goals, bucket list items that we wanted to check off. And then our Thursday assignment was to think about that same exercise, but our 25th year reunion. I don't know how many of my fellow students did this, but I did. And the amazing thing was I was able to find this envelope in both 2001 and 2016 when our reunions came up. And what was interesting is that I wasn't even sure what I had put in there. I kind of vaguely remembered the topics that I had been interested in, but I had kind of no idea what the goals that I had set. I'll share with you one of the pages from my 25th year reunion. And the only reason I block out some of the goals that I had set is I don't want to influence you as you think about your goals, and I want to encourage you to do that. But I do want to thank you for helping me satisfy one of the goals that I had set for my 25th year reunion, which was is to be a mentor and an angel investor for small startups and entrepreneurs. What I found in opening these envelopes is that when I opened my 10th year reunion envelope, all but one or two of those items I had met. And when I opened my 25th year reunion, what I realized is that several of those goals I had met by my 10th year reunion, and really most of all but one or two of those goals I had also met. So I kind of think you think it's kind of a silly exercise, but I almost think it's like reading your cases before you go to bed at night. Somewhere in my brain, these goals were percolating. In some respects, I wish I'd set more aggressive goals. Maybe our company would have grown to 200 million in revenue, but it was a worthy exercise, and I think it drives home a point which is valid for your business plans. Is that Bill Gates said we overestimate what we can accomplish in a year, and I see this all the time in business plans. But we underestimate what we can accomplish in a decade. So think of that as you put your plans together. And I would implore you to go home tonight, or maybe tomorrow night, because I know it's late there, is write down what you hope to accomplish by your 10th year reunion and your 25th MIT reunion. And again, spend no more than 5 minutes, put it in an envelope, seal it, write on it, open in 2048. For your 25th. And then I would just ask you to, I wish the professor that asked me to do this was actually no longer around on my 25th reunion. I wish he had, so I could have shared some of these ideas with them. So I know some of you are thinking how you're going to contact me. My email address is right there. Some of you are thinking whether I'm going to follow that professor and make it to your 25th reunion, but I checked the IRS tables, and the IRS says I will just make it. So please look me up in 25 years and let me know what you've accomplished. So let's get to why you're here tonight. You want to start a business. Maybe you want to win the 100K contest. Maybe you want to do both. Use the 100K as the launch pad for your business. So let's think about what your job as CEO or as a member of the founding team is. What's the number one job? And I usually make this interactive, and I will say the responses that I typically get are that the CEO should be thinking about developing the product. What's our product going to be? What are the features? Maybe what's the price? What's our selling price? Who are our customers? I heard in the earlier discussion about building that founding team. And so what members do we need on your team? And those are all critically important, except there's one that's even more important, and that is having the money to do the things that you want to do. Because if you can't hire the people that you need, if you can't buy the supplies that you need, the computer equipment that you need, then all of these plans are just wishes, right? So you've got to have the cash both to get the business started and to keep the business running. So where's your business plan? Your financial plan, your business plan is the roadmap that helps you determine how much cash you need. And we're going to go through step by step and show you how to build that roadmap. The second thing is it's the vehicle. Everyone thinks about the second thing is I need to put together a business plan because we want to raise some money. But until you put together your business plan, you don't really know how much money you need to raise, and you don't know how long that money is going to last you. So you can't think about when do we need to raise the next amount of money. There are software packages that will help you put together a business plan. Think of it as like TurboTax for business plans. And I would urge you not to use those programs, because what you'll find out in going through the process of building this spreadsheet, when I say I'm providing the template, you're going to supply the numbers for this. And what you're going to find as you plug in the numbers is you're going to look at the end result, which is the income statement for a number of years, and you're going to determine, you're going to have to identify what your assumptions are and what the key drivers for your business are, and then how long it's going to take to reach major milestones, and then what are the risks that you face. So if you expect we're going to get revenue at the end of year 2, we're going to start generating revenue, and you want to test out, is it going to take us, what happens if it takes us an extra 6 months to get our product ready? You have a way to test that and see what the ramifications of that are. I mentioned at Reveal, we had 9 fundraising rounds in the first 4 years. As you can see, twice a year, sometimes 3 times a year, we had some sort of fundraising event. And I can tell you, I could spend an hour talking about each of these rounds of fundraising and kind of even just what they are. But the message that I want to get across is that as soon as we closed a round of fundraising, and sometimes even before we closed that round, I was always thinking about the next round. How much money did we need to raise? When did we need to raise it? And who would be the cheapest, where would be the cheapest place to get that money? Would it be from venture investors? Would it be from a bank? Would it be venture debt? So we had a lot of options available to us, and I was always looking as to whether the cheapest source of money was the best source of money. Sometimes it wasn't. Oftentimes it was. Sometimes the cheapest source of money couldn't provide the money that we needed, and so it really wasn't a viable option. So what are we trying to put together with the business plan? In simple terms, we're putting together an income statement or a profit and loss statement for your business. And for those of you who are in the MBA program or who have some accounting experience, bear with me. I just want to kind of get everyone at a level set here, understanding what I'm talking about. So the income statement, the top line is the sales number or the revenue number. And this would be after any discounts that you provide. So let's say someone does a quantity purchase and it would normally cost $10,000, but because they're buying so many units, they're only paying $8,000. You don't show a line in your income statement saying sales were $10,000 less $20,000 in discounts. You only get to put in the $8,000 in revenue. Underneath that is the cost of goods sold. And if you're building a product, it's the cost to build that product. It's the labor that goes into building that product. If you're hosting a website, it's the cost of your Amazon Web Services, but it's also the cost of the technical support team from your company that is supporting that website. Let's say you have technical support answering customer problems, having access to your website, it would be in there as well. So it can be technical people, but it's not your R&D people who are developing the software or the product. Here, the next line is really just a math function. We take the sales minus the the cost of goods sold, and that gives us our gross profit. But I think I generally am more focused on not the actual dollars amount in the gross profit, but the percentage. And I can tell you, I've worked in businesses like NetScout that had 75 to 80% gross margins because our product included so much software, which has a very little marginal cost, right? We're just loading software onto a piece of hardware. And I've worked in businesses that have a 50% gross margin, which was the bomb detection company, where we were building a machine about the size of a Volkswagen Beetle that we sent to airports to screen for bombs going on the planes. We had a 50% margin. I can tell you, it's fundamentally harder to make a substantial amount of money with a 50% gross margin than an 80% gross margin. Below the gross margin line is you have your primary departmental expenses. That would be sales and marketing, that would be research and development, and then general and administration. General administration, I generally put in both your accounting department, your HR department, your internal IT department. I would put rent in there, and we'll talk a little bit about allocating expenses and why I think it's kind of a foolish exercise for early stage companies. And we'll talk about that in a second. You add up all the expenses, you subtract the expenses from the gross profit, and that gives you your operating profit, also referred to as EBITDA, which would be earnings before interest, taxes, depreciation, and amortization. So it's a long sounding term, but I would focus, but operating profit is great. Any questions so far? Okay. As I mentioned, your business model is your income statement in percentage terms. I talked about the numbers here, but I think more important than that are the percentages. I talked about why the gross margin is so important, and then as you look at the percentage spending in your let's see, do I have your percentage spending in your departmental expenses, you start to realize, or you're starting to explain what's important to us. Where do we have to really spend money to generate this amount of revenue? And here it's clear there's a lot of sales and marketing for this company to generate that amount of revenue. So that's what I think about when I talk about the business model. And what I want you to do is develop your income statement or business model over a period of years, so that if you need to reach a critical mass in terms of geography, so you need to have coverage over the whole New England area to have economies of scale, or maybe it's unit volume, right? Whereas the first 10,000 units that you produce are going to cost $100 each, but once you kind of get to that level, then you'll see the prices drop down to $80 each, or $50 each once you reach a 10,000 volume. And as you'll always be getting economies of scale, but at some point they start to diminish to the point where it's not critical to the business that you achieve greater economies of scale. It could be the number of transactions or the number of customers that you have. And your business model, as I said, it explains what the dynamics of your business are, particularly how much sales and marketing you're going to need to generate revenue. I was working with one company as a consultant, and it was a web-based business, and they were actually doing a pretty good job of growing their revenue. but they called me in to look at their numbers because they weren't making any money. And the reality was is that it was costing them more. It was costing them more in sales and marketing to bring in a customer than their gross margin. So they were selling, I don't know, $100 product in round numbers, and they had about a 50% margin. So they had $50 in gross margin, and their sales and marketing required to get that $100 sale was close to $50. And I said, unless you can get that sales and marketing down, you don't have a business. So when you put together your business model, you're documenting to investors that this business can make money. So everyone says, well, how do I figure out how much revenue I'm going to have? And let me just tell you two ways not to do it. I would say I see especially the first one all the time, and the second one not infrequently. So I got this term from a MIT Enterprise Forum presentation back when I was a student there, and it's stuck with me ever since. So let's go through the mitten model, right? China's a big country, right? It's got 1.4 billion people. Everyone has two hands. And so the total addressable market for mittens is 2.8 billion mittens. And if we could just get a 1% market share, which, I mean, how easy should that be, right? Our unit sales would be $28 million units, and at $5 a mitten, we'd have $140 million in revenue. It sounds silly, right? But let's say that instead of selling mittens, you're selling some sort of iPhone app, right? Maybe it's a weather app. Maybe it's some kind of tracking app. You know, there's tens of thousands of them. And you say, well, 500 million people have iPhones. It's probably more than that, right? And if we could just get some small percentage of those people, think of how much money we would generate. Well, it's the same fallacy here. No one is entitled to 1% market share. No one is entitled to 0.1% market share. Market share has to be earned, customer by customer. And don't think that the people that already have that market share aren't going to try and fight as much as they can to hold on to it. The other one, the checkerboard model, is a little more simple. You start it with a checkerboard in square one with a penny, and you say, hey, all we're going to do is every square, we're just going to grow at 100% per square. And so the ending value by the time you get to square 64, I'd like to let people guess. You'd never guess it. It's 92 quadrillion, starting at a penny and doubling at every square. So, okay, 100% growth rate per year or per square sounds aggressive. Let's be conservative here and say that our growth rate is only 50% per square. It still comes out to $1.2 billion. And again, no one is entitled to grow at any percentage per year. You have to document how you're going to do it. And let's go through some examples of that. So I'm calling it the bottom. There's really two options. One is the bottoms up approach, or to talk about the sales funnel, depending on what market you're going after and how you're selling your product. Let's talk about bottoms up. And so in this case, I'm saying that someone is making sales calls. You have a salesperson making a set number of calls per month. We assume that they can make one call per business day, and they're going to close 10% of those calls. So they're going to have 2 sales per month at $62,000 per sale, $125,000 per month, 1.5 million per year. And with 5 salespeople, we can generate 7.5 million in revenue. You could take a 0 off all of these numbers, or you could add a 0 to all these numbers. The reality is you've got some assumptions, some concrete assumptions that you can first explain to investors And if they have experience in your industry, they'll either say that seems to make sense, that seems to be in line with what I hear from other companies in this space, or they're going to call bullshit and say this isn't going to hold together. The second reason to spell this out is that as you hire your first salesperson, you can see how many calls they make a month. You can see how many sales they close per month. You can figure out what the average selling price is and then fine tune your model as you go forward. You may determine that they're making 10 calls a month, closing one sale a month, and the average selling price is $25,000 per sale. And you may determine that no matter, for every salesperson we hire, we're going to lose money. Well, you got to go back to the drawing board and figure out a new model at that point. But if you don't have your assumptions spelled out, you don't have anything to go back to you don't have anything to go back to start adjusting. Let's talk about the sales funnel. Everyone's familiar with the freemium model, and let's kind of walk through this, right? So you say, okay, we get 100,000 visits to our website, and 5% of those people download the app. So that would be 5,000 people. And of those 5,000 people, 20% of them actually use the app, right? So now we have 1,000 people using your app, but only 10% of those are going to convert to paid. The rest are just either going to keep it as a free or they're just going to quit using it. So you have 100 people that convert to paid. And if your revenue is $20 for that app, you're going to generate $2,000 in revenue. Now, how much does it cost you to get a visitor to your website? Are you buying keywords? Are you putting ads up? Are you using social marketing? And so you have a host of social marketing people to drive traffic to your website. I am plugging in a penny per person to get those 100,000 people there. Well, that's $1,000. In this case, you're generating $2,000 in revenue, but it's costing you just the marketing component $1,000. You only after you start adding a couple of zeros to these numbers do you figure out that whether you have a business or not. Because at $2,000 worth of revenue, how do you even pay yourself with that, right? So let's look at an advertising model, right? So let's say you have 100,000 visits to your website and you're selling ads to someone else at, let's call it $2.50 per CPM. It all depends. These numbers are all over the place. So don't take these numbers as gospel. Think about the model though, and then you can plug in realistic numbers from your business, from your market, and see how it all plays out. So at $2.50 per thousand, you're generating $250 worth of revenue. Some percentage of those people actually click through to the ad, and those you get a higher charge because they're more likely to buy. So you get $1,500 in click-through revenue. Your total revenue is $1,750 per day, $638,000 per year. Again, unless you add a zero to all these numbers, you're not going to have a business that is going to get anyone too excited. And the question is, how much does it cost you to get a visitor to your website? And so what's your customer acquisition cost and what's your retention of those people? As to put it in a little bit of a perspective, there's a yoga instructor called Adrienne who has 5 million subscribers. And I don't know whether this revenue number is accurate or not, but I did read it in an article somewhere. She generates $2.5 million a year in advertising revenue. Well, getting 5 million YouTube subscribers is not easy. So this is, in my opinion, a very tough way to build a business unless you happen to catch lightning in a bottle and have some kind of hook into the public that will get get people to follow you, but it's a very tough, in my mind, it's a very tough business. So let's talk about your financials. Here's what we're trying to put together. We're trying to put together a 4-year plan showing your revenue, and I've got this broken out by 2 types, product revenue and support revenue. And then you have your cost of goods sold, again, 2 types of costs, your product cost and your support cost. And then your departmental expenses. You have your engineering or R&D, you have your marketing and sales, which I treat separately. Those could be combined together. And then you have your general and administrative. So this spread, so what we're trying to do is put together this. This is the end result of what we're trying to put together. As you show that, I see a lot of business plans, and when the first thing I do is I turn to this page, and the first thing I look at is the top line. How big is this business? How big do they think that this business can be? And the reality is that a company that's trying to grow to $10 million over 4 years is a lot different than a company that's trying to grow to 50 million or $100 million over 10 years. Now, let me preface this by saying I'm helping you put together a business plan that will help you, A, maybe win the 100K contest, and B, hopefully raise money from investors. And so I'm going to give you a bunch of rules of thumb that don't necessarily apply if you and 2 of your classmates decide we want to start some kind of consulting business, or we want to start this little lifestyle business. It's going to be the 3 of us. We'll have 3 other employees who won't be equity owners, and maybe you grow the business to $2 million, right? And your overhead is only $500,000, and the 3 of you split $500,000 a year, and you love the lifestyle. That's a great business, but that is not a business that anyone is going, other than maybe your mom and dad or your uncle, are going to invest money in, because that's not a business that has an exit scenario. It can't go public. It's not big enough. It can't be sold, because really the only assets are the company or the 3 of you and what you bring to the table. So bear with me on a couple of these rules of thumb, but if you have that kind of small business, nothing wrong with that. I'm just really focusing on it on a different market. So I look at the total revenue as we're getting going. The next thing that I look at is in year 4. Is this business, and especially right down here, is this business going to be profitable? And then I look at the gross margins. I've told you, I really, it's so much easier to make money with a great gross margin. Is this a realistic gross margin? What types of product are they selling? And then where are they spending their money? Do I think that they can spend this much revenue, $11 million in, let me do sales and marketing. Sales and marketing of $15 million and generate $66 million worth of revenue. Does that seem credible? And then I would, if it does, then I'll turn the page and dig deeper into the business plan. We'll get to common mistakes that I see in a couple slides. The next thing that I look at is the operating profit over the 4-year period. So here's a company that lost $4 million. The parentheses are negative numbers. I probably should have put those in red, but then I'd have to do another color code here. The company lost $4 million in the first year, lost $2 million in the second year, and made $7 million in year 3. So I kind of go, okay, they used up $4 million in year 1. They used up $2 million in year 2. There's probably a couple million of other expenses in there, maybe capital expenses. So this is a company that they think that they can get to $66 million in revenue, raising about $10 million. And if this is your business plan and you like it, you go, as you're thinking about how much money do we need to raise? Do we need to raise 5 million? Do we need to raise 10 million? Do we need to raise 50 million? You can start to put that into perspective about how much money you want to raise. And we'll talk about milestones in a second, but maybe you want to raise enough to get to certain milestones. And then the next time you raise money, you'll have a much higher valuation because you've gained some critical mass. So as you're putting together the spreadsheet, I've color coded this to make it easier for you to figure out what's going on. When you share this with anyone, there's going to be a bunch of things on here that you won't share. You won't share this column here where the source is. This is to help you understand where this data comes from. You won't color code anything. So, so this is a great working template, but in order to finalize it for presentation, you'll have to do a little bit of cleanup. So if it's in blue, it's a number that is coming from another spreadsheet. So you would not go in and change this to $2 million, fat finger that right there. We have to go to the source document and change it there so that it'll feed up and tie together. So the bottom line is, if it's blue, don't change it. If it's black, it's a calculated number. So you can't change this number. This number is the calculation of these two, so don't change this number. If it's black, don't change it. If it's magenta, you'll see that it's from another spreadsheet feeding a spreadsheet. And if it's red, now we get to the numbers that you're allowed to touch. So we see on our 4-year spreadsheet here, everything comes from somewhere else, and everything actually happens to come from the P&L by quarter. So let's look at that. So think of a spreadsheet here. I'm just showing the first 6 quarters, but this is really going to be 16 quarters, right? 4 years, 4 quarters a year. So this goes out many more columns. As we look at this spreadsheet, we see everything is still in blue. But we start to see that things come from different places. The revenue numbers come from the sales plan. The cost of goods numbers come from the cost of good page. So this template that I'm going to send you has about, I don't know, probably 8 different pages, 8 or 9 different pages. And you'll have to modify each of those individual pages that will then feed into this. And how I would suggest you do this is you go in, you make your assumptions. The first thing I would do is I would go and start, just like I look at the top line, you should go in and plug in your sales assumptions and then come back to the prior page here and look at your revenue and say, is this the number that we want to roll out to the public, that we want to show to investors? Is this a number that we believe is obtainable? And if it's not, then go back and change the assumptions behind these sales numbers before you start figuring out, because before you start figuring out how many people I'm going to hire in sales and marketing or in engineering or in G&A, because if you have $40 million in revenue, these departments are going to look far different than if you have $80 million in revenue. So get this section of the spreadsheet right first. So we look at here and we go, well, everything comes from the sales plan. So we'll go to the sales plan next. But before we do, this comes from the cost of good, and this comes from your departmental expenses. So now let's go right into the sales plan. I've made it kind of simple here. I'm showing a business that's selling some product, but modify this. These numbers could be completely flipped. Instead of 20 units at 10,000, this could be 10,000 units at $20 a piece. It doesn't. What matters is you understanding your assumptions, putting them in the spreadsheet, and then seeing what the results are, and asking yourself and your fellow founders, do we like it? And if you don't like it, then sometimes you need to go back and fundamentally rethink your business, and then come back and start this again. So we have product revenue. And as we see here, I've color coded these magenta, which means that they're going to another spreadsheet, and we know that they're going to the quarterly P&L spreadsheet. Support revenue is it's common in certain industries. If a customer buys a product from you, let's say they have $100,000 worth of product, you would typically, it's not uncommon to charge them a 15% per year support fee under their support agreement, and they would get a couple things for that. One is they would get any product updates, they would get technical support if they had questions. It could even, if it's a hardware product, it could even include hardware support. So if the product breaks, they would get a new product. Those are all terms that you need to figure out for your business and what's common in your industry. But it can be a great source of recurring revenue because as your installed base grows, that support revenue tends to stay in line with it. But of course, you're not going to keep 100% of everything that you sell, because customers switch to another vendor, customers go out of business, customers decide we just don't need ongoing support. So I've put in an assumption of 75% for my template. You get to decide what's a reasonable number there, and then you can see how the support revenue grows over time. Let's look at cost of goods sold. Just for helping us think about cost of goods sold, I've carried over the unit sales information from the prior page just to help us look at how big the business is growing, so that when we come down here and think about how many employees we need or what our variable costs are, we can look at the volume that's being sold. So if we're selling 330 units per quarter, our unit costs might drop, depending on economies of scale. So you also, if you need manufacturing people, so here we have a VP of manufacturing, we have a supervisor. So, the supervisor is actually a calculation. The technician is a calculation based on however many units you need. As you grow your sales, you need more technicians to build the product. And then depending on the number of technicians you have a certain number of supervisors. So I would urge you, whenever you're building your model, to put formulas in wherever you can that are driven off of other numbers. Now, you can always come back and revisit those assumptions, but it means that there's less fat fingering of numbers in here. And you're going to be doing a lot of that as you go back to that 4-year spreadsheet, looking at it. You're going to be coming back to these spreadsheets and making a lot of changes. It's a time-consuming process, but you'll slowly go from having too much revenue to having too little revenue, and you'll start oscillating, and you'll finally get to what is a sweet spot for what you think your business can do. In this case, we have our staffing cost, and I'll show you we'll show you a salary page in a second. We also have our variable cost per unit. So here it's $1,500 per $1,500. These are the variable costs. So even though we didn't sell any in Q1, we know that the variable costs are $1,500. And if we decided we could sell in Q1, then we already have the number in here. And as you can see, our variable costs go down over time as we achieve economies of scale. And here we have 3 different models. We introduced model 2 in Q1 of year 2, and those prices go down as well. And the rest of this is just the math of the unit sales times the variable sales gives you our variable cost. And then our staffing costs up here give us the salary and benefits. And then there's a facilities charge that I add in for the dedicated manufacturing facilities. Staffing is going to be 50% of your expense. And so you're going to be spending a lot of time on this page for each department. And you just plug in the head count of number of people that you expect to have in each category. I would urge you to have as few categories as possible and just use an average salary per category. So in engineering, have a programmer, don't have a senior programmer, junior programmer. You just put in one programmer and assume a base salary for that, and that will be good enough at this stage in your financial projections. So with salary projections, we have the number of people. And in this case, I'm saying the chief technical officer is probably a founder, so he's taking a haircut on his salary. He or she is getting $175,000 a year, and we divide that by 4 to get a quarterly expense. But we also have to add, we pay taxes for that person. We also have to provide health insurance, maybe not in the first year, but certainly by year 2, as you start to grow your company, people are going to they're going to expect that you're going to provide benefits. And 15% is a pretty good number to add on to salaries to cover those expenses. But what happens in year 2 is people expect to see a raise, even though they're working at a startup. They're funny like that, and you need to bake in those raises in order to be competitive. So this line is kind of a clever way of baking these into your projections. And here it's a 2% overall increase per quarter starting in year 2, which works out to 8% per year, which is probably a pretty good number. Now we have a lot of inflation now. Maybe you want to bump those up to 2.5% per quarter or 10% per year. But those are pretty good numbers. They have a huge impact on your expenses out by year 4. But if you don't bake them in, you're going to be underrepresenting your expenses in year 4, because people are going to want raises or they're going to walk. So you better be prepared for it. Non-salary expenses, we've talked about departmental expenses. We bring in the salary expenses from the prior 2 spreadsheets. We just add in, I put some categories here. You put in the categories that are relevant for your business. Again, anywhere you can use a formula. Here I have a formula of $2,000 per person per month for each engineering staff. It sounds like a lot, but I tell you, engineers can spend a lot of money on stuff, and it's always, when they come and tell me about it, it's always critical. So this way, I don't need to put those numbers into my spreadsheet. I don't need to fat finger those in, because I've already got the head count and the number here. So anywhere you can do that, I would suggest you do it. And then generally every department, you have a little bit of a miscellaneous category, and you just kind of plug that in and grow it over time. Here's the other departments. Sales, I have travel per person per month at $3,000. This would be for salespeople who are going out into the field. We have a commission number here, so that's driven off of revenue, and then other expenses. General and administration is primarily staffing account, and then you plug in something for the lawyers, and then you plug in something for rent. And I have the next page we'll talk about rent. And then here we have telephone and internet. This is basically your IT department per person per month. And then you just input some miscellaneous expenses. So you bring those all together. That brings us back to our quarterly P&L. While I don't think I have the rent calculation in the spreadsheet, in this presentation, it is in the spreadsheet itself. It's a whole new world, right? Everyone's working from home. No one's going into the office. So I will tell you my formula is way out of date, but and you probably can get by without any rent for the first year or two, right? But you will have to eventually, I think, plug something in there for rent. So look at the formula and modify it as necessary. So we brings us back to our quarterly P&L, and our quarterly P&L feeds into our annual 4-year P&L. Any questions on any of that?
Yes, Charlie, we have one question from Zoom from Cassandra, who asks, what are the key differences, if any, should we think about it when it comes to nonprofit or social benefit ventures?
Well, nonprofit ventures don't make a profit, right? So, I mean, I'm on the board of several nonprofits, and kind of our goal is to raise as much money as we can, and then spend that money supporting the cause the cause that we're supporting. You're allowed to keep some of that and grow, keep some money in reserve. I think that people looking at supporting your organization are a little leery if there's too much cash in there. But I do think at some point you can build up an endowment. But in reality, and staffing, whereas I talk about technology company staffing is going to be 2/3 of your expenses because you have some product and other expenses. I think in a nonprofit organization, salaries are probably going to be 80 or 90% of your expenses. Again, it depends on what you're trying to do. If you're building wells in Africa, well, then you've got a lot of cost of goods or cost of what you're delivering. So it really depends on the nonprofit. But I think that a lot of these rules still apply. I hope that helps.
Great, thank you. We have another one here in person.
Okay.
Hi, Charlie. Can you please
Hi.
also talk about stock-based compensation? Because right now, I think what you're focusing on is only cash expenses. And
Yes.
since it's a very early stage, so maybe, stock-based compensation is not part of the conversation. But how do you view it as an investor once a company is, more mature than it is right now?
Yeah, so I think investors ignore stock-based compensation, meaning, I guess let me ask you a question. Are you talking about the accounting of, I gave Jane $50,000 worth of options, and so therefore I need to take that expense of the stock options that I gave her over a period of years? Or are you talking about dilution from giving stock to employees?
I'm talking about dilution
Okay.
and also like from a valuation perspective, because most of the adjusted income or adjusted profits, we did a study last year where, I think 35% of the companies that were profitable had more than 20% of their income, because of SBC. So how do you see that as an investor?
So I'm a little confused there, because as a company, you would not have income based on stock-based compensation. You would have an expense based on stock-based compensation. I guess let me cut to the chase here. Stock-based compensation, and so I apologize for those who, this is a little bit of an accounting, and I don't mean to be negative on this, but it's a little bit of a accounting rabbit hole that we're going down. The reality is that stock-based compensation takes zero cash. So it's a non-cash expense. It's an accounting expense. And if your company is doing $100 million worth of business and it generates $20 million worth of revenue, but has $20 million worth of stock-based compensation expense, well, then it would look on the books to have zero have zero profit, but yet it's a company that's generating $20 million in revenue. Now, it may be tough to go public with a company like that, but there are plenty of PE firms who would love to buy a company that's generating $20 million in cash, regardless of whether GAAP accounting says that it's making money or not. So I don't want to get too bogged down in this. We will talk about dilution at the end if I have enough time. So I hope that answers your question. So again, as we get back to your financial plan, what you should look at is I would look at your top line. As you're building your financial plan, here's what I would suggest you talk about. Here's what I would suggest you would think about as you're putting together. Look at the top line. Is this the growth that we think is credible, that we want to see, that we think we can achieve? Then do what I did. Look at your percentages out here in year 4. Do we like these numbers? Are they attractive? Do we think investors will like them? Are they too good? Many business plans have these numbers are way too good, and I'll show you some in a second. Then the next thing I would do is look at your expenses in year 1. It's very credible. You can think about these numbers in year 1, and you can kind of you can say, here's the 5 people I want to hire. Here's how much they're going to cost. So you can think about what these numbers, if you can't hit your expense numbers in year 1, then you're either not budgeting appropriately or you're not following your budget like you should be. It should be pretty easy to hit your expense numbers in year 1. Whether you're going to have that $1.7 million in revenue in year 1, that's a huge question. But your expense numbers, this 4.966 in operating expenses, that is entirely controllable by you. And then you can project that out to year 2. And then what I would say is year 3 is really kind of a melding of years 2 and 4, so it makes a nice, slow, steady progression. So you've got to know your cash flow, and I have a simple way to do it. It's look at your monthly burn rate, your cumulative monthly burn rate, plus any capital expenditures you need. So let's take a look at this, and this is in your template as well. And the red is you plugging in how much and when we think we can raise money. And what you should always do is have your ending cash greater than 0, right? So you can't operate below 0, because that means that you owe people a lot of money, and eventually that will catch up with you. So here we're taking from the quarterly P&L, we have our revenue. Remember, revenue is you send out an invoice, it takes you a quarter, it takes you 30, 60, 90 days to get it. So I assume for these purposes that you're going to get your revenue. This is the Q2 revenue, but you're going to get it in Q3. But your costs of goods are not deferred because your vendors need to get paid and your employees want to get paid. And you also have some capital expenses. So this kind of tells you how much cash you're going to burn through. And it shows you, wow, I'm down to $923,000 in cash. I need to raise money. You can figure out by looking out at your next 6 columns, how much money do we need to raise before we're going to be either profitable or we're going to have some milestones to show investors. So we've got about 15 minutes left. Let me just rush through these business models because I really want to get to the equity part. These are just some retail stores, and all I want to show you is that, of course, they have huge costs of goods sold. Why? They're buying stuff from other people. They're selling it to you. They've got to pay for the stores. They've got to pay for the salespeople. There's a lot of expenses in that. They have no R&D because all they're doing is buying stuff. They're not developing product, and they have marginal. They can only afford marginal sales, general and administrative expenses. Why? Because they have such terrible gross margins. And look at the operating profits here, 5 to 10, 11%. One of the interesting things is I think it's looking at revenue per employee. And you should do that in your business plan. And you'll see in the template that I sent you, I have revenue per employee as a column just below everything. And that's for your information. And it's something that you should track. You shouldn't share it with anyone, but think about your business and how much revenue you're going to be able to generate per employee. What I often see is people fail to recognize how many employees they're going to need to grow the business, double the business this year, double the business. People will double their business 3 years in a row, but they won't double their employees 3 years in a row. And what they'll end up having is 60% of the people that they need because they haven't built the right organization to support their business. So here we have revenue per employee in the 100,000, 180,000 to 100, kind of 150 to 200,000 per employee. Let's look at restaurants. Again, terrible gross margins, no R&D, revenue per employee in the $50,000 range. Let's look at some tech companies. Now we're starting to get interesting. Like we have, except with the exception of Dell, which is selling computers, everyone else has got really good gross margins, but they do spend a fair amount of money on R&D, 10 to 15%, and they have operating profits, again, depending on the business, in the 20 to 30% range. And look at the revenue per employee. It's about 300,000 up to 600,000. Some software companies, even better gross margins. I love these businesses. Look at the operating profit here. This is before tax, of course, for Microsoft and Oracle. Revenue per employee, though, even at 645,000 per employee, is not, is not terribly out of line with some of the hardware companies. A little less for Oracle and SAP. And then we have Google, kind of crazy here, $2 million per employee. Facebook at $1 million, and other tech companies kind of in the $500,000 plus or minus range. So don't delegate building your financial plan. Don't hire a consultant to do it. Do it yourself with you and your team. Generate those sales from the bottoms up. Do not project best case, worst case. When you show your plan to someone, to a potential investor, say, these are our numbers. We believe them. And don't overwhelm them with, and one thing you should never do is use the word, these are conservative projections when presenting to a potential investor. I cannot, you can ask them how many times they've heard someone miss their wildly conservative projections. It happens all the time. So let me just skip this. The one thing I will say is you've got capital expenses. Don't depreciate them, if that makes sense to anyone who knows a little bit about accounting. Don't allocate your G&A expenses. At the end of the day, you're just taking money out of one pocket and putting it into another pocket. So it has no impact on the bottom line, makes things way more complicated. Do not start to calculate your tax. Just show your profit, show your loss until you're profitable, show your profit off into the future. Everyone knows that taxes will be due eventually. Don't waste time doing that calculation. I've mentioned some of my rules of thumb. I guess the key thing here is your R&D. I would expect for a tech company for it to end up at about 10 to 20%. G&A is generally in the 5 to 15% range. And I guess what I want to drive home is build a plan that has an operating profit in it. If you don't build it in, then it won't happen. And if it's going to take 6 years to get there, then put together a business plan that lasts for 6 years. If you say we're going to be like Amazon and we're going to operate in the red for 20 years, well, good luck. There's only a couple companies that can get away with that. And to think that your company is going to be one that's going to be able to continue to raise money and operate at an operating loss for a hugely extended period of time is, I'll be blunt, it's a little naive. Grow your sales projections to $50, $100 million per year. That's a real company. That's a company that has options. maybe not going public at that level, but certainly getting acquired. But it's also a company that has the optionality to grow to 500 million with additional investment. So you don't need to show that your company is going to grow to 500 million in 4 years, because no one will believe you and you'll never get there. Revenue per employee should be about 250 to 500. And I'm using, if you have salespeople, think of how much you're going to have to pay your salespeople, and they should be bringing in, somewhere between 4 to 8 times their annual cost. As I mentioned, the number one problem I see is showing revenue way too high, over $100 million. And I also see operating profit way too high. Let me just show you the top 50 tech companies, and this is their revenue per employee. And the two outliers in this year's data were Netflix at 3 million and Facebook at 2 million. You can see them up here. If we take them out, all of these companies have revenue per employee. Only a few are over $1 million, and most are well under $1 million. So just keep that in mind. You're not going to have revenue per employee of $1 million. And in terms of profitability, look at some of these companies here. Microsoft, Facebook, they have 34% profit. You're not going to have a 50% operating profit. No one will believe you, and they'll question your understanding of your business if you go in and say, these are conservative numbers, we're going to grow to 400 million with a 40% operating profit. So I just wanted to back my rules of thumb up with data from real companies. Your average employee salary is going to be 100,000 or more. Add the benefits. Your salaries are going to be the lion's share of your expenses. So when you look to cut costs, or you look where your expenses are your profitability is too high, then add salaries. Your profitability is too low, take out salaries. Okay. When dealing with venture capitalists, they don't want you to starve, but they do want you to be hungry. So pay yourself what you could get if you went and worked for another company. Maybe take a little less than that, because the more money you save, the more money you save, the less money you raise, and the less dilution you'll have. And I want to get to that. So just because your title is CTO, don't pay yourself $300,000 unless you were a CTO in another company and everyone in your management team is has been a C-level executive and was making that kind of money. In that case, you and your team get to decide, do we want to pay ourselves $250,000 a year, or do we want to pay ourselves $150,000, raise a little less money, and maybe hold on to more equity? They also don't want you to spend your own money, but they do want you to spend it like it was your own. So venture capitalists appreciate being careful with their money. Now let's talk about equity distribution. I thought there were some great comments from the panel. I want to say the first one was, you've got to have that founder discussion before you have any other discussions. And I'm going to show you a spreadsheet that will help you see what the impact of those discussions are going to be, but also show you how many people you're going to have to give stock to over time. And I thought that there was a great comment that said the venture investors, they want to get a certain amount of ownership. Now, in this example, I said 50%, maybe it's 30%, but I thought it was a great suggestion. Raise as much money as you can, because they're going to take at least 30% anyway. So don't give up 30% of your company for $4 million if you can give up 30% of your company for $10 million. And you'll see in the spreadsheet how you can play around with some of that and the impact of it. I don't have time to go into the venture capital formula, but come back to this page, and it's simple. And you guys are, you guys are all MIT students, so you'll figure this out. This will be easy to you. So let me skip this because I want to get done in time. Here's an example of dilution. And so we have the columns represent funding events. So at founding, we have 4 founders. Then we have some early employees come on. Maybe we did a little self-funding before this. Then we have an angel round where they put in 500,000. Then we have a VC round where they put in some money. And then we have a VC round 2 where additional money came in. And we'll walk through all of these. When you think about the team, think about the commitment that people are bringing to it. Think about what their future contribution is going to be. It's all about the future, not about the past. So it's the work to be completed, not the work that's been completed. I asked this question, but it didn't get relayed to the panel. I think everyone should vest over 4 years, everyone on the founding team. And the reason is the last thing you want someone to do is jump ship after year 1 and walk away with all his or her equity when the other 3 founders are sitting there sweating it out. And at the end of the day, that person gets 100% of the equity compensation that the other founders are getting. Whereas if they're vesting, they walk away from that. Here's where I think ownership should be after 2 rounds of financing, but founding management team could get 2 to 3x this, and founding employees might even get 5 to 10x this. But remember, you can always grant more later. So remember how I talked about the spreadsheet for the business plan. You notice a trend here. I always like to start at the end and see, do I like what I see here? If not, then I need to go back to somewhere in here and make some changes here. So a couple things I want to look at here are, these are per person percentages. So I want to see my managers at about 0.25%. I want to see my senior engineers at about 0.1%. Maybe junior engineers, a little haircut on that. So I would need to make sure those numbers kind of ring true when I plug these numbers in. So at company founding, we have the 3, we have Jack, Susan, and Anil, and they decide to split up 50%, 25%, 25%. We then bring in some early employees. Again, maybe the founders all threw in a little money to bring people on board. We bring in some advisors, and they're all getting some equity, and these are the number of shares that they're getting. Our founder, I'll just look at Jack, for example. He gets diluted from 50 to 44%. We then have some dilution here. The angels invest $5 million at a 4.5 million pre-money. Again, this would more likely be a safe investment, but you can imply what you think that it's going to be for your own internal purposes. It's not a valid cap table, but it's pretty legit. And so 500,000 on a 4.5 pre would be, you add those 2 together. So the post money is 5 million, 500,000 out of 5 million is 10%. And then you just plug in the number of shares that gives them their 10%. And this happens automatically in the spreadsheet. So now Jack is diluted down to 40%. We then have our VC round. They raise 5 million at a 5 million pre. The venture investors get 50%, but they forced us to add to our option plan. And so that dilution gets taken out of everyone except the venture investors. We could have a half-hour discussion on that, but it's going to happen if you raise venture money. What happens to Jack is he is diluted down to 15% now. And then there's one more round here where we did another round of 10 million at a 15 pre, which would be 10 million divided by 25 as the post. I know I'm throwing a lot of numbers at you, but that's a 40% dilution, a 40% equity stake. But notice the VC round 1, they also got diluted down to 30%. So it isn't like you gave up 50% and then you gave up 40% or 90%, this 50% gets diluted to 30%. Your angel investors who came in at 10%, they're now diluted down to 2.3%. But the founding management team is diluted down to 9.1, 4.5, and 4.5. Now you sit here and say, I don't know, how big are we going to grow this company? What's it going to be worth? Should we plug in 100 million? Should we plug in 200 million? Should we plug in $1 billion? That's up to you. But you plug in a number and you say, okay, at 100 million, Jack says, well, I'm going to get 9.1 million. Susan's going to get 4.5 and Anil's going to get 4.5. How does everyone feel about that? Does Susan or Anil feel cheated? Does Jack feel that he didn't get enough for the work that he brought to the table? If you aren't happy with where it's going to end up here, then you gotta discuss it here. So this spreadsheet that I'm going to send you is color coded. You can enter in all of the yellow fields. All these yellow fields you enter in, everything else takes care of itself. And then you can come out here, and the only thing I didn't do is add a column and say, hey, if we sold the company for $1 billion, how much money would I get? But you can absolutely do this. So I think you'll find this a very interesting spreadsheet to play around with. The last company I joined, they did not have something like this. The founder was kind of willy-nilly handing out shares to people. I said, Jack, we got to come up with a plan here, because we got to keep, everyone's going to find out what everyone else has in equity, in stock and stock options, and we got to make this fair. If someone got 20,000 and someone else got 30,000, we got to be able to explain that, other than I like the guy, right? Or he negotiated harder. So you got to be able to explain that to people, or else they're going to feel that they got cheated. So I don't know if we have enough time for questions, but I'm open to what we have time for.
I think we do have a question or two here.
Okay.
Hi, Charlie. Thanks for talking to us tonight. For a B2B software company, could you give 2 or 3 metrics that you think are really critical, whether that be liquidity, profitability, or valuation?
A B2B software company. I mean, it really comes back to revenue growth. Look. Maybe I don't understand the question about liquidity, but if you're growing a business, it's about having enough cash to develop the product and do the sales and marketing that you can get in front of the businesses that you want to sell it to, and start generating that revenue. If I'm missing something, please rephrase the question.
No, that's fine. Thank you.
Okay.
I have 2 questions. One is, do you have any kind of a logic behind why the kind of VC don't want the founder use your own money? The second one is, usually I hear like people create like 2 class shares. The founder can have like kind of more voting rights and stuff to remain control of the company, even though their equity gets diluted. Do you know how the process kind of negotiated, or how to do
Okay,
it?
yeah. All right, good question. The first question was not, look, the venture capitalists would love for you to spend your money. It's not that they don't want you to spend your money. It's that they don't expect you to spend your money, because you're running a business, right? So don't take that the wrong way. So you don't need, what I would say is, if you're going to spend your money, spend it before you raise the venture money, because hopefully that'll help you have a better story to tell and help you increase your valuation. The second question, can you just remind me, what was the second question?
Oh yeah, like for example, like I think in Facebook or like Snapchat, they have like 2 class of shares, like the founder have them.
Okay, yeah, 2 classes of shares. Okay, this is way out of your league. Okay, so some people can get away with that, but for all the companies that I've worked with, at the end of the day, the founders have common shares, the investors get preferred shares, and I'm sure you've heard of the golden rule: he who has the gold makes the rules. So you're going to get to negotiate what terms they have in their preferred stock. You're not going to be able to negotiate a ton, but you'll be able to negotiate some. If you have two people bidding to make the same investment, you'll have more leverage in that negotiation. But you're going to find that there are things that are generally non-negotiable, like creating an option pool of approximately 10% of the current outstanding shares, giving them anti-dilution rights, giving them participatory rights. I would caution everyone in the room. There's often a fear of owning less than 50% equity in your company. And I believe that is a red flag to most investors, because growing companies almost always end up with the founders controlling less than 50% of the company. And if people are concerned about that, it makes them concerned that you're not going to be willing to raise the money necessary to grow the business to 100 million or 500 million or $1 billion, because you're so worried about control. At the end of the day, your venture investors, yes, they have control. And I'm sure we've all heard stories where entrepreneurs say they got the raw end of the stick, the raw end of the deal. They got forced out of their own company. There's usually a lot more behind the story. The venture capitalists that I've worked with, they've been firm, but they've been fair. They want to see you succeed. The last thing that they want to do is bring in a new management team. The chances of a new management team succeeding are generally far less than the original management team succeeding. And so I would caution everyone. I'm not saying give up equity willy-nilly, but don't think of that 50% line as a line I'm never going to cross.
All right, thank you.
Thank you, Charlie. We're going to have Joe wrap up now.
Okay.
Thank Charlie. We would have loved you here in person, but this worked pretty well, I think. And the template, both the equity distribution template and the actual financial projection templates are on the Nuts and Bolts website. And so take a look at it and play with it. So thank you, Charlie. Are you off to heli-skiing next?
I actually am. I leave Friday for Revelstoke, Canada.
So he likes to get dropped, on a helicopter on the top of a mountain and ski down. And so I try to get him to do this before he does that, because, who knows? So thank you very much. Have a wonderful time. Come back safely. Thank you, Charlie.